Peter's Principle 18. When even the analysts are bored, it's time to start buying. So this one might be one of my favorites here. And we can go through several companies. So I'd love to hear you throw one out and talk about that.
I'll throw out a company that hasn't performed as well as we'd hoped. But if you look at the historical returns and what we think will happen.
Love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
All right, folks, welcome to Investing for Beginners podcast. Today, Andrew and I are going to take 3 of Peter Lynch's principles, and we're going to talk about how we have applied those to our investing journey. So these are associated with the book Beating the Street, which is easily one of the best beginner investing books out there. Super easy to read, lots of great information. But before we dive in today, we'd love to hear from you. So we are running a listener survey, and everyone who participates will get entered into a raffle for a $500 Amazon gift card. Plus, the first 100 people to respond will receive a free Investing for Beginners coffee cup and coaster set. Head over to einvestingforbeginners.com/pod survey. That's also in your show notes. Your feedback will help make the show better, and we'd appreciate you taking a few minutes to share your thoughts. Again, that's einvestingforbeginners.com/pod survey. You must be 18 or older to fill out the survey, and terms and conditions will apply. So with that, let's go ahead and dive into Peter Lynch's principles and how we've applied them during our journey.
Yeah, let's do it. Peter Lynch is such a great investor. He had incredible track record. You should go look him up. So the first Peter's principle we will dive deep into is you can't see the future through a rear view mirror. So what does he even mean with that, and where have you seen that in the markets?
Basically, the way I interpret it is that the future results of the company you can't see through the rear view mirror. So you hear all the time companies talk about, past results don't guarantee future results. And while it can tell you a story, it doesn't always mean that what has happened in the past will continue on forever and that you should just take that for granted. And that's kind of how I've always thought of it. What about you?
Yeah. You saw it with Nike, right? Like, yes, pretty vividly and almost like a train wreck in slow motion.
Mm-hmm. Yeah. Very, very much so. So what do you think caused Nike to go through that train wreck?
Yeah. Well, I'm not like a sneakerhead, so I can't say for sure, but we did buy Dick's Sporting Goods, and they are, if you're not familiar with, I'm sure you've heard of the store, but what makes them different as a stock is they are the leader in their specific niche, which is sportswear. And so one of the things Nike did, which I believe management has since backtracked on, is they made a push to go direct. Like, they have these Nike stores, and going direct can be great, especially for a brand like Nike. And I think Apple was always shown as the poster child. Like, if you go direct with Apple stores, you're gonna win, right? So I think that was some of the mentality behind Nike going direct. But it seems like they swung the pendulum so far that they weren't respecting some of their retail partners like Dick's Sporting Goods. And so I remember at the time when Nike was really getting into that direct thing, you would hear Nike's earnings calls, and they would always be like very positive about how they're going direct. And it was actually impacting retailers like Dick's Sporting Goods. And if you remember Foot Locker, I think that really hurt them because Nike was such a big partner for Foot Locker being a much, much smaller concept. And so it kind of was a situation, this is my interpretation, I might be biased as a shareholder, but it was like a lose-lose proposition. Like, Nike loses sales and the retailers lost sales. So that could have played some part into it. There could be a whole fashion thing going on too. I can't comment on that part, but that's kind of what I saw. And so Nike had great, it's always been like, if you want a quality growth stock, you buy Nike. It's not going to be like a tech company, but it's going to trounce the market. And it did for so long. And then for whatever reason, the last 5 years, they've really stumbled. And that's affected not just the stock price, but also their financials. Revenue growth has not been nearly where it was. And that can, when you pair that with a valuation compression, it can lead for a very painful shareholder experience, I'll say.
Yeah, for sure. Yeah, definitely. And this is very anecdotal, but my daughter and I were at the mall here in Wilmington last weekend, and just walking around, we walked by a Foot Locker, and I was surprised it was still open, and it was in a mall, but there was literally two people in there, both employees, both standing there looking at their phones with literally nothing to do. And then we walked a little bit further down the mall, and there was a Dick's Sporting Good entrance inside the mall, and it was huge. And there were so many more people in the Dick's walking around, shopping, buying things, walking through the shoe area and that kind of thing. It was such a night and day experience. It was a little bit shocking. So to your point, you can sometimes see that just, on the ground, walking through the stores and seeing some of those things. So yeah, it's really eye opening when you see that kind of stuff.
I've seen that also. I mean, we're pretty close to each other, Raleigh, Wilmington, but yeah, exact same experience for me with the malls and Dick's Sporting Goods. It's pretty like, wow, eye opening.
Yeah. Yeah, for sure. Are there any other companies that maybe through the rearview mirror have, done pretty well, but have stumbled since?
Yeah, HP comes to mind. I don't know if you do this too, but like I vividly can remember when I've like researched a company. So like back in must have been like 2021, I remember having my printed out 10K of HP Enterprise, and I was like at the pool reading it. I don't know. Like, do you like have visual memories of where you've learned about a particular business, or is that?
Yeah, for sure. Like I remember reading about, it was S&P Global. The first I had downloaded a bunch of 10Ks on my iPad because I was flying to Brazil, and so I had 11 hours of uninterrupted time to do things. And so I decided I would be industrious and read some 10Ks. So I vividly remember sitting on the aisle row and reading the 10K as they're dimming the lights, and
nice.
Feeling like I'm being so productive.
Yeah, right.
But I remember reading the 10K on my iPad, on a flight to Brazil. So yeah, it definitely happens to me all the time.
Okay, cool. I don't recommend printing out and bringing to the pool. That was just like an experiment, but I guess I still have a printer, which actually HP, that is what they're more focused on now. Not an expert on the company, but I'll just go based on my memory. If you remember, HP back in the day was one of the PC leaders. Like they were up there. It's Dell, HP, maybe IBM. I don't remember about IBM, but definitely HP was a big one. And then in more recent years, they really struggled because they kind of, as you see, I think with a lot of these titans of business, as they get bigger and bigger, they start to run out of places to grow. And so you get companies that have a little bit of this business, a little bit of that business. One of the businesses that HP got into that really got hit by innovation was like data center servers. And so what they ended up doing was they split the company off. There was just the HP Inc. and then there was HP Enterprise, which had the IT, which was basically garbage. If you look at that stock chart, I think it was terrible. I remember reading those reports and being like, ooh, like lots of red. I don't think you want to see this much red in a spin-off company in their financials. So yeah, that's kind of what happened with HP. And I wasn't around when they kind of had that fall, but I wonder, so I speculate if the whole Lenovo thing really succeeding kind of helped unseat HP. And then, not to mention, like, I actually do have an HP printer. Not going to say whether I like punted my last one or not. You can just use your imagination. But I don't know why I bought the same one. That pissed me off. I'm still stuck with this HP printer. And I'm probably one of the few people left on the planet who actually have a printer, but that was a big part of their business as well, printers. And as we all know, we hardly ever print things, especially with the advent of QR codes and NFC and all of those things. So maybe that's a bigger kind of longer term example of how the innovator's dilemma can hit a company. And you see it more often than you think in technology.
Yeah. Yeah, absolutely. And I haven't had a printer in a long time. And so I haven't had to experience that frustration that you've experienced. But yeah, I don't even remember the last time I needed to print something. And if I did, I most likely went to the library. So just because that's just an easier way to do it. And yeah, it's interesting how something that was so dominant during a period of time just eventually fades. I distinctly remember my father he worked from home for a while, and I remember him using a fax machine, for example, and how that was like just so cutting edge at the time, and then it became obsolete. And he had a printer as well, and how that has now become obsolete. So it's really interesting how some of these things that were once so dominant can just kind of fade into the history books.
Yeah, 100%. All right. Well, what about like the flip side? Maybe a company where the rearview mirror wasn't as rosy, but they were able to turn things around. Do any companies come to mind for you?
Probably one that has certainly gone through a peak and a valley and then a peak again would be Microsoft. The company during the unmentionable period, the Steve Ballmer years, for anybody that invested in Microsoft during that period between the .com and Satya Nadella taking over, probably gives them goosebumps or the willies thinking about how poorly the company did during that period. And I know you looked it up, and the company was doing around 5 or 10% revenue growth during that period, which isn't horrible, but it's certainly not awesome. And it struggled for a long, long time. And I don't remember the exact numbers, but from the .com peak to Satya Nadella taking over, it was flat or down during that entire period, which was a 13 or 14 year desert, if you will, for investors. And once Satya Nadella took over, then the company has certainly seen much rosier times. That was around 2013 or 14, somewhere in that time frame. And the company has been much better. 2015, maybe. The dates are eluding me, but the company is fortunes have certainly been much better consistently since then.
Oh yeah, 15% revenue growth is more the standard for them rather than the exception, which is incredible at a company of their size.
Yeah. I mean, when you think about an almost $4 trillion business doing revenue growth 15, 16, 18% annually, it's like, oh boy. Yeah, that's doesn't suck.
No, it does not. It does not. And Nadella's done a lot. He's done a lot of great things.
Yes, he has.
They acquired GitHub, which that's huge in software. Everybody talks about the cloud. That was a big one. The way he basically took Ben Thompson talks about this. He took 3 divisions. The company was basically like separated into 3 pieces, and they all bickered with each other, and none of them collaborated, and they were all territorial and bureaucratic and everything. And he went in there and fixed it up.
Yeah,
that's cool.
Yeah. I mean, I think it would be an understatement to say that was a good hire.
Yeah.
Whoever made that decision, made a really good choice. For sure. And he doesn't get he certainly doesn't get the same accolades or maybe recognition that a Steve Jobs or a Bill Gates would get, because he wasn't the founder of the business and he wasn't instrumental in starting the business, but he certainly has had a lot of success since he's taken over, and he certainly put the company in a much better place going forward than they were previously. And the same could be said for Tim Cook as well. Tim Cook has certainly done a masterful job of managing the business since Steve Jobs passed away. So and I don't think they get enough credit for the job that they've done. And, it gets swept under the rug because they weren't founders.
Yeah. Plus, like, what have you done for me lately?
You're right. Yeah. Yeah. It reminds me of that Russell Crowe scene in Gladiator. Are you not entertained?
Right. Yeah.
Are you not entertained? Yeah.
That'd be a great meme. Put their faces on there.
Right. Yeah. Right. Are you not entertained? So, are there any other companies that you could think of that maybe in hindsight didn't do so great, but are now doing better today?
I mean, I'm sure there's a bunch. Nothing immediately springs to mind, and we do have 2 more Peter's principles to get to. So maybe we could
let's move
put
on.
a pin on it.
Yeah. Let's put a pin in that. If it comes into our heads, we'll come back to it. But yeah.
All right. Sounds good. Moving along. So the next Peter's principle, Peter's principle number 11, the best stock to buy may be the one you already own. So I know you've, another way to say this is dollar cost averaging up. So I know you've done this. Why does this work, and why did you do it, and how did you do when you did it?
I've done pretty well with it. It is a mind shift that is harder for value investors, because our natural inclination is to buy things when they're on sale, i.e. when the stock price goes down. So if you're looking at Microsoft, for example, and you see that the stock price drops, your natural inclination is, hey, okay, it's on sale, let's go buy it. As Buffett would always say through the years, I like to buy everything on a discount, my stocks and my socks. So that's our natural inclination. Something I kind of learned from Brian Feroldi and Brian Stoffel, and tangentially David Gardner, is this idea of averaging up. And what it revolves around is, as the business gets better, you buy more of it because it still will create more value as it goes forward. One of the biggest hurdles with that is anchoring on the stock price. So if you bought a company at $100 and it goes up to 150, now you air quote think this is more expensive because it's $50 more than when you bought it. But it also could mean that the company has grown revenues at 20% and the ROIC has improved and the margins have gotten better. So now it's a more valuable business. So why wouldn't you buy it at 150 and air quote average up? Because then you can partake in the gains that it continues to gather as it improves. This is something I've done with a few companies in my portfolio. Visa is one that I won't bore everybody with. But other companies like Adyen, Brookfield Asset Management, now Brookfield Corporation, Topicus, all these companies I have averaged up over the years. And Google, I did the same thing. I averaged up on Google as well. So these are companies that I've continually to buy as they've improved their financials. And I've done well with those companies, and it's all part of the dollar cost averaging system, because you find a really good company, and if you can find a good value and buy it for more, you're still going to achieve that improvement in the value. But it is counterintuitive to what we think of as value investors, so that's what makes it hard.
Yeah, it totally does. That anchoring thing is so hard too. Like you saying, like you bought at 100 and you look at 125, it just looks way more expensive. Mm-hmm. And there's some, I think, psychology behind that. It's just kind of how we're wired. And we just have to remember that the market and the stock don't know that you've bought it. So we have to separate our own egos and our own life stories with like the practical reality that businesses are not stagnant just because you bought it. It could be a different business 6 months from now, and could be, to your point, a better business. So to kind of double click on the anchoring idea, out of the companies you listed, was there one where it was like you bought it pretty cheap and then it got a little bit more expensive, but like from a unbiased perspective, it's like, okay, it's still like a good deal, but maybe it was harder for you because it's like, man, I remember buying this cheaper and now I have to buy it a little bit more expensive. But then, you are ultimately glad that you did.
Yeah. Besides Visa, the other one would be Google.
Mm.
I didn't, hindsight, I timed it, but I didn't.
Okay.
So when the stock got down to, I don't know, 80 some bucks a share kind of thing, I bought some. And then as I did more research on the company, I decided that it was still really good value at 110. And so it was really hard though to buy it because I was still anchoring on the $86. So it took me a lot of thinking about it to like move past the, okay, stop being so cheap. Is this company going to be better? Am I going to be happy that I bought it at 110 5 years from now? And I kept coming back to the answer of yes. So then, okay, why am I anchoring on 86? I should anchor on 110. And I'm using relative numbers. I don't remember the exact number, but my point being is that once I move past the, okay, I got to stop being so cheap and try to pull the trigger, then I was happy that I did that, and I did it a few more times after that as well. So it was harder to do. I've been doing that all along with Visa, but to me that's a different story. And so it just feels different. But Google recently was definitely one that I struggled with to move past that. It was hard.
Yeah, and I also don't remember the exact numbers or the exact dates, but I'm pretty sure you bought before I did, and I think I kind of missed like the really nice dip, but I got in on like a less nice dip, and that stock has up to now. I mean, it could change tomorrow, but it's doubled up to now. So you've done really well on that, and probably have done better than I have. And so it can be worth going through that suck because there will be great rewards on the other side.
For sure. And the other thing that can make that hard too is the narrative around that. So the contrarian part of it is that you're being positive about what you see and what you think the future of that business is, but then everyone around you is negative Nelly. AI, Google. AI is coming for Google. Open AI is coming for search. Bing is coming for search. All of these things you're inundated with it, and you just see it everywhere you go. And so if you're on social media, if you're reading blog posts, if you're listening to podcasts, everybody is casting negative about what's happening with Google. Any negative news that comes out gets amplified. And so when you're trying to average up into a company that's going through that, and you think it's hard because you feel like you're on an island alone. And there's maybe some voices of reason like Andrew or Ben Thompson from Stratechery that are a lot more logical about it, but there's an ocean of people that are not being logical about it and are just reacting. It's one of the downsides to social media for sure, is that particularly on X, everybody's an expert of the day, whether it's the Google AI trade, or whether it's Lululemon, or tariffs or whatever. Everybody's an expert, and they're not afraid to voice their opinions even when they really don't know anything more than you do. So that can make it hard.
It is a lonely place. I mean, I wouldn't recommend doing it, but you could go up to like your spouse and be like, "Are you not entertained? I was on an island and I made all this money." I know, like with my spouse, my wife, it didn't work. She's just like,
right, same. Yeah.
What money? I'm like, well, we reinvested it. She's like, so what money? I'm like, long term,
long term. Long term, yeah. Just you get the eye roll, and you instantly tell they do not care.
Yeah, the things I do. All right, moving along. Peter's Principle 18. When even the analysts are bored, it's time to start buying. So this one might be one of my favorites here. And we can go through several companies. So I'd love to hear you throw one out and talk about that.
I'll throw out a company that has not hasn't performed as well as we'd hoped. But if you look at the historical returns and what we think will happen with the company going forward, I think would definitely apply. And this is Danaher, which is the life science business. And they are a kind of a long-term stalwart in the industry, and especially they're a leader along with Thermo Fisher in what it is that they do. It's 8-9% return since we invested in it. So not awesome, but not horrible. But certainly does not get a lot of love. Analysts are not excited about this company. You will never see anybody on social media talking about it, podcasts talking about it, blog posts rarely, or people talking about it because the narrative is it's a boring company, and nobody really cares. And those could be some fantastic places to mine for investment ideas. I know you got
I like
some
that you. Oh, sorry. Go ahead.
No, go ahead.
I was gonna say I love how you mentioned Danaher because that one's almost by design under the radar. So one of the weird things about stocks that do a lot of spin-offs, and I don't know if there's like really an easy solution to this, is when a company spins off, so like Danaher, for example, if they spin off, like they did the water related business that they spun off a couple of years ago. So when you look at the financials for Danaher, their revenues, the whole business looks worse because they no longer have the water business in the financials. But if you were a shareholder, which I was at the time, you received shares of the water business. And so when you're looking at the stock price for Danaher, where it was at the beginning, where it is now, that's not your whole return. Your whole return is where was that at the beginning, where is that now? Plus, where is that water business and those shares that you got as part of owning Danaher, and what is that worth to you now? Maybe, unfortunately, I haven't gone back to look at this. I don't know if I should have just hung on to those shares or if it was good to sell and reinvest in Danaher itself. But that's a big one of like these companies that acquire and spin off and acquire and spin off. They are by design looking not as great as the real reality is for shareholders.
Yes, for sure. I know part of the return for a company like Constellation Software recently has been the spinoff of Topicus, which I mentioned earlier, and also Lumine. Both of those were business segments for Constellation Software, which they spun out, and both of those segments have done really well. Since they were spun off recently, the company and the spinoffs have had some struggles, just because of the narrative around the business and AI and whatnot. But for shareholders in Constellation Software, that was certainly part of their return. And I know several people, including our friend Adrian and Brandon from Fiscal.ai, are big Constellation Software fanboys and shareholders, and they have enjoyed having those returns as well from those other companies. So yeah, that's definitely a part of those business returns that you can partake in.
Yeah, for sure. I'm gonna throw, unless you're dying to say McKesson, I'm gonna throw McKesson in the mix.
Say it. Speak it.
Yeah, McKesson, another 2023 company from Value Spotlight. You just, for whatever reason, I can't understand why, people just don't get excited about medical distribution. Why not? Why not? That's fascinating. But like in all seriousness, when will you see a medical distribution company be talking about AI or crypto or plant-based foods, whatever the hot story is of the year? You just won't see in a mature old industry. McKesson's been around how many years? Over 100, right? Like,
yeah, I think so.
I know it's over 100. I think they're up there in like a very select few businesses in the S&P that have been around like X number of years. So it's like it just hasn't changed all that much. Like, yeah, there are things, and there are things that they have done that help push the stock forward. I know I haven't looked into it recently, but I know they've gotten into more of, I don't want to call it holistic stuff, but just more services to kind of help the customers they already serve, kind of an idea. So yeah, some of the return is driven by that, but the cash cow kind of steady business that they've always had continues to chug along. And so if you're an analyst there, maybe you're just like bored to tears every time you have to go to an earnings call and ask the same questions. But it's just one of those examples, I think, of you want management to at least paint a bright picture of the future, and they do, and they certainly do. But the level of excitement is not near the level of excitement you'll see for a company like Palantir or Nvidia or AMD or Tesla. Like, it's just on different complete levels, but it doesn't, the excitement and the hype does not correlate to future stock price returns. It just doesn't.
Right. No, it doesn't. And, boring can be beautiful. Right. And I think a company like Fastenal, who I don't own, I've never owned, I've looked at it briefly. But I think over the last 20 years has had phenomenal returns. And, it's a nuts and bolts and equipment company. Like, it's, way off the beaten path of exciting businesses, and really the only thing that makes it exciting is the returns that you've been able to enjoy if you are a shareholder of that business. And but it would definitely be a poster child for a boring business. And so yeah, that companies like that, I think, can be kind of the backbone of investing. And if you can find those kinds of businesses that are necessary and will do really, really well for a long time, they can give you fantastic returns. I'm not sure what Waste Management's returns have been, but I'm sure they're pretty darn good. And it's a garbage company. Like, how unsexy is that? But it's necessary. So that's what makes it strong.
Returns, how boring. You're making money, right? How boring. I want to be able to flex. Come on now.
Yeah.
I want to say I bought Nvidia at 2018.
Right. I want to be able to go to the gym and tell people I bought Waste Management back in 2014.
Right.
And see the eye rolls.
Yeah. What about you? What's another company that you can throw onto this list?
I would say Watsco would be a really good one. I mean, an HVAC distributor is, far from sexy, but it has, enjoyed fantastic returns. Not only since you bought it, and since we have owned it, and I think since its inception has done extremely well. And that is way off the radar. Other than the returns, you don't hear anybody talking about Watsco. It's, if I go on, any of my social media accounts, you're not going to see people talking about Watsco at all.
Why do you think that is?
I think, it's air conditioning. Like, it's a necessary tool, especially for those of us who live in warmer climates. You cannot exist in Arizona without an air conditioner. It just doesn't happen. And so, but it's not exciting. It's not sexy. It's not, analysts are probably not lining up when they're divvying out, okay, what companies are you going to follow? I would hazard that not a lot of arms are getting raised. Ooh, can I watch Watsco? Can I follow Watsco? Probably not a lot of arms are getting raised to do that. I remember our friend Todd Wenning was talking about. I think he was assigned to cover the waste management or sector, and I remember him kind of saying how boring that was. So. It's probably one of those things like where new analysts get stuck with the really boring industries, and as they progress in their career, then they can advance to the sexy things like an Nvidia or something. So, I think it's just not people. It flies under the radar, and I just don't think that people really think about the necessary businesses unless they're really serious about trying to turn over a lot of rocks, I guess is the best way of putting it.
That actually reminds me when we had Todd on, he had, I'll call it colorful language about how that whole game is played.
Oh,
As
yes,
far
he
as,
did.
do you remember that?
I do.
Yeah.
I don't remember the specifics. I'd have to go back and listen to the episode, but yeah, I do remember he was very elaborative, shall we say, of the games that are played.
Yeah. And I don't mean colorful like he cursed or anything. I just mean like, he shed some light on some of the things in Wall Street that some retail investors aren't aware of. So you can search for us, Investing for Beginners podcast, Todd Winning on Google, and you should be able to access that episode. It was a fun conversation.
Yes, it was. Yeah, super smart guy.
Totally. So throw another company on here. You got any others that come to mind?
Yeah, I would say something like a Martin Marietta would certainly fall under that category. They have, aggregates, right? Like nobody talks about aggregates. That has got to be one of the more boring industries out there. But it's been a fantastic business, and they've done really, really well.
You know what's funny about that one? They've painted a good picture. So there's there's stuff there. They've mentioned how data centers in particular are pretty aggregate heavy, but it's one of those things. It's kind of like high school, Why did certain kids get popular? It's like, I don't know, hard to say. At least in my high school.
Right. Yeah, it was kind of the same here. It feels a little bit like a stretch to say, to connect Martin Marietta to AI, but
True.
but that's kind of today's market.
Mm-hmm. Are there any stocks where you think that tie is just ridiculous? Like you're really tying that company to AI, and it's just so obviously a hype story,
right? I'm sure there are that I've seen. I'm struggling at the moment to think of a company, but I know that there have been a few, over the last little bit that, when the management throws out, and it's not just one time, and they talk about it, maybe not the whole call, but it just feels, okay, this is, you're stretching the reality.
Mm-hmm. Mm-hmm. Yeah. I don't want to like throw out names because I realize now that that might not be the best, but some companies rebrand regular software and call it AI. And it's like, is it really AI? It's just, you're literally just using software, but
right.
I guess in a way AI is software, right? So, well, according to experts, it's our next frontier, which I don't disagree with, but at the same time, I get like .com vibes.
Right.
If you haven't studied stock market history back during 1999 and 2000, there's a common thing. You can read it in different books. All you had to do back then was attach a .com to your company name and your stock price would jump. It was almost like easy money, right? And so I think we can all figure out how that story played out.
Yeah. Pets.com is probably the poster child for that. That's for sure. Yeah. It doesn't seem quite, about a year ago. Yeah. Every earnings call, doesn't matter what company you're listening to. Somehow they were mentioning AI in the earnings calls and any sort of presentations. It seems like it's smoothed out a little bit since then, but yeah, there was like every single company, and I'm not going to throw out names, but yeah, there was a lot of that for sure.
Whatever happened to the metaverse? Do you know?
I believe it's been downsized, shall we say? I know that Zuckerberg has been, I guess, thinning the herd, so to speak, in that division of the business. I believe they're still putting money towards it, but now I think it's more related to the glassware aspect of that, as opposed to, the alternate reality kind of thing. I think that is, I don't want to say it's died, but it certainly feels less like that's a thing for them anymore, for sure. But I know the VR, like the VR AR glasses, is still a thing that they're working on with the Ray-Bans and that kind of stuff. But it's certainly been diminished.
Yeah, I did like randomly, one of the YouTube channels I follow did like a VR type video on YouTube that you can watch, and then I guess you put your glasses on. So that could be cool. I mean, I watched it and I didn't get it, obviously, because I don't have glasses.
Right,
I just try to watch it on my regular TV. But I'm not trying to say that every hype story is the same. Some hype stories live on, but some sometimes take a different form. So I'd be curious to watch the metaverse, because I do see potential in that whole idea, and I see potential in like the glasses and all of that. We don't really know how it's gonna necessarily land. Like, I remember when plant-based food was like the hottest thing on Wall Street. And you can argue there has been disruption in grocery, if we want to call it that, with all the protein foods that are out now. And you wonder, like, did the plant-based movement pave the way for everything we're seeing in protein now? And I would argue, which puts me on an island for a second, I'm going to be on a Darrell Revis island. So, you all can not agree with me and just be wrong. I'm cool with that. But I think the protein thing is here to stay. I think people have a deeper understanding about nutrition, and I think they just generally want less calories, higher protein. But I will not argue that stuff is nasty a lot of times. And if it's not nasty yet, come back in 6 months and you'll be like, I cannot have another one of these protein cereals or whatever it is. Like, I get it, but I don't know, I say all that to prove, hopefully, that like the hype cycles, they all come in different forms. But we can learn from the past to try to not make the same mistakes in the future. And if that leads us to companies that are less fun and less in the news, it's okay, because those companies often make great returns.
Right. Yeah, for sure they do. And, a question I would ask people to think about, would you rather have company A, which is far more exciting, but only returns 5%, or company B that's way more boring, but returns 12%? Which would you rather have?
Yeah.
I mean, I think we'd all rather have B, but there's a lot of people in the market that would much rather have A. And I mean, that's part of the market that we have to air quote contend with. But it is a good question to ask yourself. Would you rather, what's more important to you? Is it having a sexy thing that you can talk about at the gym, or is it more exciting to have something boring that you can't talk about at the gym, but makes you more money in the long run? I know which I'd choose, but I'm pretty sure I know which one you would choose too. But
well, I don't want to publicly say that I enjoy making money. That would be egregious. I could never do that.
No, definitely can't do that. All right, folks. Well, with that, we will go ahead and wrap up our conversation for today. Before we let you go, I want to remind you that we are doing a listener survey, and everyone who participates will get entered into a raffle for a $500 Amazon gift card. Plus, the first 100 people to respond will receive a free Investing for Beginners coffee cup and coaster set. So head over to einvestingforbeginners.com/pod survey. That will also be in the show notes. Your feedback will help us make a better show, and so we'd appreciate you taking a few minutes to share your thoughts. Again, that's einvestingforbeginners.com/pod survey. Must be 18 or older to apply, and terms and conditions will apply as well. So with that, we will go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week and take care. We'll see you next time.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market, shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.